Hi, this is Analyzing Transaction video number 4. So, in this video, we're going to focus on new terms and just some different types of transactions that the students will come across. So, we're going to start this video on page 43 in the Southwest 10th edition accounting textbook. On page 43, you have the January 10th transaction. And the transaction reads, received cash from sales $1,100. Received cash from sales $1,100. So, how do we analyze this transaction? So we start up here with page 43. The date is January 10th. And we must determine which two accounts are affected by the transaction. Received cash on account from sales. So if I receive cash, cash is affected. So cash is one account. Received cash from sales. Received cash from sales. So sales is the other account. Cash and sales are two accounts affected. Remember, there's always going to be two accounts. Can be more, but never less. Two accounts are always affected. So where do these accounts fall into the accounting equation? Cash is an asset. Sales is owner's equity. What is the normal balance of an asset? It is debit. What is the normal balance of owner's equity? It is credit. So we have our normal balance column completed. So now we have our plus or minus. The question we ask is, do we have more or less of this account based off the transaction? Received cash from sales. Received cash from sales. So if I received cash, I have more. My cash went up. So that is a plus. If I receive cash from sales, that means I have more sales. So my sales went up. So that is also a plus. So when it's a plus here, the normal balance stays the same. So normal balance means how an account is increased, plus mathematically means to increase. So we put debit, credit. Debits always come first. We always write debits first. So what account do we debit? Based off the change column, we debit the cash account. So we write cash over here. Which account do we credit? Based off the change column, we credit the sales account. Sales go here. Okay, so that transaction is analyzed. So now we're going to analyze another transaction. We're going to go to page 45. We're going to go to page 45 in the textbook, and we're going to analyze a new transaction. And this transaction is for January the 12th. Paid cash for communication bills for cell phone and internet services. Paid cash for communication bills for cell phone and internet services, $80. So we're on page 45. So this is page 45. And the date is January the 12th. January the 12th. So we always check our chart of accounts for the name of accounts that we want to use when we're analyzing our transactions. So communication bills, if we go to page 3 in the chart of accounts, you will see that there's an account labeled communication expense. Communication expense. So this is an expense transaction. So the two accounts that are affected, paid cash for communication bill for cell phone and internet service. We have cash and communication expense. So I'm abbreviating communication expense account. But if you go to page 3 in your chart of accounts, you will see the communication expense account. So remember that expense is a part of owner's equity. There are the four accounts that make up owner's equity. So we're going to do a quick review here. So we have expense, sales, drawing, and capital. Remember, the left side of a T chart is debit, and the right side of a T chart is credit. Normal balance. Debit, credit. So this is an expense. Okay? So when we get into expense, the analyzing chart can get a little tricky to explain because we've been able to easily focus on the account. We can look at the account equation to figure out where it all fits in. So I'm going to explain this transaction two ways. Okay? So first, we're going to do the normal thing we all know. Cash is an asset. Communication expense is part of owner's equity. So the normal balance of assets is a debit. The normal balance of owner's equity is a credit. So when we get to the plus or minus, we ask ourselves, do we have more or less of the account based off the transaction? So this is where it gets a little tricky with the owner's equity. So the normal balance of assets is debit. We pay cash for communication bills for cell phone and internet services. So if we pay cash, we have less cash. Okay? So let's first look at this from owner's equity. If I pay cash for communication bills and I'm going to have a communication expense account, if I look at the owner's equity normal balance is credit. So expense normal balance is debit. So in this case, a debit reduces owner's equity because remember, this whole thing is owner's equity, and the normal balance of owner's equity as a whole is credit. So expenses reduce owner's equity. So if I have an expense, that means I have less owner's equity because I use the owner's equity normal balance here. So I put a minus. Okay? So in this case, we do minus, we do the opposite, that's a credit to cash. Minus, we do the opposite, that is a debit to owner's equity. So now we get to our change column and we look at our debit and credit. So what account do we debit based off the change column? We debit communication expense. And what column do we credit based off the change column? We credit cash. So I'm going to analyze the same transaction again, but I'm going to do this part a little different. Okay, so it's the same transaction, but I'm going to do this part a little different. So I'm going to set it all up again. So we got page 45, January the 12th. So the transaction again is paid cash for a communication bill for cell phone or internet and internet service, $80. So my two accounts are affected are still cash and communication expense. Okay. So here, how does it affect the owner's equity? It is still assets and it's still owner's equity. But I'm going to focus on the fact that this is the expense section of owner's equity. So for owner's equity, I'm going to put a little slash and put the word expense. Because now I'm saying I am focusing on the fact that this is the expense section of owner's equity. So when I get to the normal balance section, I'm going to focus on the normal balance of the expense account. I'm going to focus on the normal balance of the expense account. So here, assets is still debit, but the normal balance of expenses is also debit. So now the question I ask is, do I have more or less cash? In this case, it is less because I paid cash. And then I ask my question, the question I ask next is, do I have more or less communication expense? More or less communication expense. And I put more. I have more communication expense. So that is a plus. So now when I get over here, it is minus debit, meaning it's minus, the change is minus, so the opposite of debit is credit. Here, the change is plus, so it's the same. So what account do I debit? Communication expense. And what account do I credit? Cash. So the end result, as you can see, is still the same. I still debit communication expense and credit cash. It's just this little portion of the analyzing chart that I thought about differently. But my end result should be the same, whether I focus on the normal balance of the expense portion of owner's equity or I focus on the normal balance of owner's equity itself. The end result should still be the same. I am going to debit communication expense and I am going to credit cash. Thank you.